Hello everybody and welcome back to the channel. In today's video that is going to focus on the first US hydrogen ETF that was launched 2 days ago. It is the Defiance Next Gen H2 ETF with the ticker HDRO. It's the second hydrogen globally launched. The first one was the LNG hydrogen economy that in our opinion has a slightly different focus on more large cap companies. We're going to do an analysis of the two ETFs and compare them in a separate video in the future. Some of the fund details, as we mentioned, it was incepted 2 days ago. The stock ticker is HDRO. The primary exchange is the New York Stock Exchange. It has 25 companies in the holding as of today, and the expense ratio is only 0.30%. We think it is relatively cheap compared to an active managed ETF like that. The fund data and pricing, the net assets is only 2.74 million. So again, not a huge ETF that we are talking about here. The closing price for one share in the ETF is $27.59 US. The shares outstanding is 100,000 and the medium 30-day spread will be 0.47. So a relatively liquid ETF as of now. So Defiance is obviously coming up for some reason why you as an investor should invest in this ETF. One of them is obviously this is very much focused on clean energy. What they're saying is fossil fuels are waning and alternative energy sources can't keep up. Green hydrogen can be made using electricity from renewable resources. They say it's the next gen tech innovation. The hydrogen market is driving breakthroughs in electrolyzers, fuel cells, hydrogen storage and transportation solutions, and fuel cell users can. Yes, we agree with that. There's definitely improvements. However, keep in mind that hydrogen again has been around for quite significant period of time and it's still not cost competitive, so there's still a way to go for the industry. Political readiness, global political will has turned towards supporting the clean energy future. Government are investing billions and legislations towards decarbonization. We completely agree with that, and especially within the hydrogen sector there's been a lot of focus, especially in the EU but also Southeast Asia and Australia. So again, a huge pressure towards this and quite big ambitions within the hydrogen sector. And finally, they say the growth potential. Bank of America suggests that hydrogen will generate 24% of our energy needs and create as much as 11 trillion in investment opportunities by 2050. A hydrogen ETF may offer the opportunity to capture some of that growth. Well, we don't know the numbers that Bank of America has used, but obviously hydrogen is expected to grow in the future. The question is by how much. Will it be competitive with some of its alternative technologies that it's competing against? Will it be as good as they expect? This is still to be seen how much hydrogen is going to play a part in the future energy mix. So the fund rules is following the Blue Star Global Hydrogen and Next Gen Fuel Cell Index, which is based and tracks the performance of a group of globally listed equities in the hydrogen and fuel cell segment. Eligible companies must generate at least 50% of their revenue from hydrogen and or fuel cell projects, or be involved in the development of fuel cell technologies or hydrogen-based energy sources, including the production of industrial gases, so long as hydrogen is included in the company's product line, with the potential for these to generate 50% of their revenue or play a significant role in the global hydrogen or fuel cell segment. So this obviously shows pretty clearly that they only want to invest in companies that are serious about hydrogen and which plays a primary role in their business portfolio. The index excludes vehicle manufacturers and exchanges in Russia, Turkey, South and Central America. So again, there's some regions and some type of companies that has been excluded. Components are weighted with a maximum of 10% for any single stock, 4% for industrial gas stocks, and no more than 50% of the index to be made up of components with a weight of 5% or more. So again, some clear rules. This is quite similar to what ARK investment is having. 10% is the maximum in general. So again, if it goes above, if a single stock grows exponentially, then obviously they will have to reduce their position to live up to these 10%. The index is reviewed quarterly with a target coverage of 85% of the free float market capitalization of the investable universe with at least 25 companies. So again, the majority of the fund is going to be invested in the type of companies that we are discussing, and it will be at least 25 companies. That is what they have as of today. If we take a look at the subsector breakdown, what we can see here that as of today, hydrogen and fuel cells is the biggest one with 66.72%, industrial gases is 21.67%, and hydrogen generation equipment is 11.62%. In terms of the companies, the largest holding as of today, which probably will have to be revised soon, is Plug Power. That is 13.64%. We all know Plug Power. We've covered them in separate videos. Fuel Cell Energy, another well-known company, 11.55%. So that will also have to be adjusted. Ballard Power Systems Inc. We also know them a little bit, 7.47%. ITM Power, Nel, we know them. Bloom Energy, Ceres Power, Linde, PowerCell Sweden, Everfuel. There's a lot of companies that we have covered in some of our videos. Some of them are new to us and maybe we will take a look at them moving forward. However, a big portion is with companies that we have analyzed in one way or the other. If we take a look from a geographical point of view, United States is the biggest one with 32%. United Kingdom follows with around 13.5%. South Korea, 13.33%. Canada, 10%, and then it goes along the way with different European countries, including Japan. So again, from a diversification perspective, we would say that you get a relatively good diversification, not just from a company perspective, but also from a geographical point of view. It's not focused too much on a specific geographical market or specific companies, although obviously Plug Power and Fuel Cell has quite high portfolio holdings. But again, similar to what ARG is doing, they have a limit on the 10% of some of the companies and less for the industrial gases. So we would say it's a quite good spread out across different type of countries and companies. So what does that overall mean? Does it mean that you should invest in this ETF? Well, first of all, we think it's good that there's coming a counterpart to the wind and solar ETFs, the TAN and the FAN that we have covered previously. It's good to finally see that there's coming some ETFs that focus specifically on the hydrogen sector. And obviously for you as an investor, it makes it easier to get some diversification if you're interested in the industry, because you get an ownership in a broad range of companies. You don't need to buy them individually yourselves. However, what we would say is also, and we covered that in one of our most recent videos, that is that we think that there's going to be a perception switch where it's just not everything that is, green that is going to grow. I think investors are going to be much more critical about the companies themselves, their performances. So we do not think that necessarily all of this is just going to skyrocket like we have seen previously. And that's obviously the case when you invest in an ETF. You get some good apples and you sometimes get some bad apples. And we think moving forward for a sector like this, it will perhaps be better or give a better return to invest in individual companies who have actually proven that they can deliver some results. For the hydrogen sector specifically, obviously, most of these companies are not profitable and there's quite some time before they will become profitable. But at least there's the tendency in some of the companies that they're moving towards that. And again, that's why we think if you can pick out some of these winners, we think you will get a better return than if you invest in the ETF sector only. However, that being said, again, if you prefer a bit more diversification and you prefer a bit more lower risk, then this is obviously a good option. And we would say that the yearly annual fees for the ETF is actually not that high, which is obviously quite good. It's only 0.30% as of today. So again, it's definitely interesting, and for certain type of investors, this will definitely be better than investing in individual companies. But we think that the best return is going to pick the right companies among the bunch, because there's some of them that we don't have the same faith in. This was all we had for today. We really hope you enjoyed this video. Please subscribe for future content. Please give us a like. It really helps with the algorithm. And please put a comment in the comment section. We always appreciate that. What do you think of this ETF? Is that something you would find interesting to invest in, or do you prefer to invest in the individual companies? This is all we had for today. Please keep in mind we are not professional financial advisors, and this is only done for entertainment purposes. Stay safe. Have a nice day. Hasta la vista, baby.